Most people think investing is complicated. They believe you need to pick the perfect stock, time the market, and constantly watch the news. But what if there was a simpler way to grow your money, without stress, without guessing, and without being an expert? That's where ETFs come in. ETF stands for Exchange Traded Fund, and while that might sound technical, the idea is actually very simple. An ETF is like a basket that holds many different investments inside it, usually stocks. Instead of buying one company, you're buying a piece of many companies at once. Imagine you want to invest in the biggest companies in the United States. You could try to pick a few, maybe Apple, Microsoft, or Amazon. But what if you choose the wrong ones? What if one of them underperforms? With an ETF, you don't have to worry about that. You can buy a single ETF that tracks the S&P 500, which includes 500 of the largest companies in the market. So instead of betting on one company, you're investing in the overall growth of the economy. This is called diversification. And diversification is one of the most important principles in investing. Why? Because it reduces risk. When you invest in a single stock, your entire investment depends on that one company. If it fails, you lose a lot. But when you invest in hundreds of companies, the impact of any single failure becomes much smaller. Some companies will go down, others will go up, but overall the market tends to grow over time. That's the key idea behind ETF investing. You're not trying to beat the market, you're becoming the market. Now let's talk about why ETFs are considered one of the smartest ways to invest. First, they're simple. You don't need to analyze financial reports or predict which company will explode next. You just choose a broad ETF and let it do the work. Second, they're low cost. Many ETFs have very low fees compared to actively managed funds. That means more of your money stays invested and compounds over time. And compounding is where the real magic happens. When your investments generate returns, and those returns generate even more returns, your money starts to grow exponentially. But this only works if you stay consistent and give it time. Third, ETFs are accessible. You don't need a lot of money to start. In many cases, you can begin with a small amount and invest regularly. This brings us to the strategy that makes ETF investing powerful: consistency. Instead of trying to time the market, you invest regularly, every week, every month, no matter what the market is doing. When prices are high, you buy. When prices are low, you also buy. Over time, this strategy averages out your costs and reduces the impact of market volatility. It's called dollar cost averaging, and it's one of the most effective ways to build wealth slowly and steadily. Now, let's address something important. What about market crashes? If the market falls, won't ETFs lose value too? Yes, they will. But here's the difference. When you're invested in a broad ETF, you're invested in the entire market, and historically, markets recover. Crashes are temporary. Growth is long-term. If you panic and sell during a crash, you lock in your losses. But if you stay invested and continue investing, you benefit from the recovery. This is why mindset matters as much as strategy. ETF investing is not about quick wins, it's about discipline, patience, and long-term thinking. So how do you actually start? First, you open a brokerage account. This is the platform that allows you to buy and sell investments. Second, you choose a simple, broad ETF. Many beginners start with ETFs that track major indexes like the S&P 500 or global markets. Third, you decide how much you want to invest regularly. It doesn't have to be a large amount. What matters is consistency. Even small investments can grow significantly over time if you stay committed. And finally, you stay the course. You don't panic during downturns. You don't chase hype. You follow your plan. Because in the end, successful investing is not about being smarter than everyone else. It's about being more consistent than everyone else. ETF investing removes complexity, it reduces risk, and it gives you a clear, proven path to grow your money over time. You don't need to predict the future. You don't need to find the next big stock. You just need to invest and keep investing. Because the real advantage in investing isn't information, it's discipline. And the sooner you start, the more time your money has to grow. So the question is not whether ETFs work. The question is, will you stay consistent long enough